Welcome back. In part one, you learned that all insurance companies are not created equally. So shopping around for not only the best rates, but the best coverage is a must. It is your responsibility to make sure you have the needed protection. That will require you to have some knowledge about insurance before you talk to an insurance agent. You want to know what perils are covered by your policy, and you want to make sure your insurance is inflation-proof. Find out if your insurance carrier offers you replacement costs for your home and its contents. If so, is there a cap on your replacement costs, and are you guaranteed replacement costs with no cap? In part two, I will answer the question about the difference between named risk and all risk policies. While price is a major factor for most people, it should not be the deciding factor. A conversation with your agent will help you to know what levers can be adjusted to get your insurance costs where you need them to be without sacrificing coverage. We will also talk about the impact filing claims can have on your insurance premiums. So let's learn more from my discussion with our special guest, LaTanya Simmons, Vice President of Aon Private Risk Management Company. Now, I want to go back, so because we're talking about real estate, and we are, we're talking about when you get a loan to buy a house, you must have, no option, you must have homeowners insurance. The lender wants to make sure that their interest is protected. We do know that you have the right to shop around. The lender can't tell you who to get the homeowners insurance from.
Absolutely.
But we know that not all companies, are the same, not all policies are the same. You have to have some idea, some knowledge base, even no matter how small it is, so that you can talk intelligently or at least understand. And if the insurance agent is sharing things with you you don't understand, you say, hey, back up, wait, I don't understand that. And if they're talking to you in a condescending manner, making you feel small, then you know that's not the person for you. We do understand, based on what you're saying, that when you get homeowners insurance, you want replacement costs as opposed to an actual cash value. And we know replacement costs is going to be a little bit more expensive.
Right.
There's also such a thing as named risk policies and all risk policies. Explain the difference, please, because will we see this on the deck page, or will it be in the verbiage somewhere?
That's usually on those other pages.
All the pages we don't want to read. Okay. On the pages we don't want to read. Explain it.
The named perils, I think we talked about that. It's about 12 to 16 different perils of what the policy covers you against. So that's pretty standard. The named peril, or the all risk, is where everything is covered except the things that are excluded. So that way, it takes care of things that you may not readily think about. And you don't have to remember all 12 or 16. So unless it's on the exclusions, it's covered.
It's covered. So now that you explain name risk versus all risk, which one is more expensive?
Typically all risk.
All risk.
Yeah.
Okay. So now I'm trying to go back because I want people to understand when they buy a house.
Yep.
Which do you have? And when a lender says, oh, my insurance company can get you a better rate, what are you getting?
Right. Or what are you giving up?
Oh, I like that better. What are you giving up? And again, people don't understand that.
Yep.
And that's when, because I think at the end of the day, if it means that they can't get the house, and for some people, it is that tight.
Right.
What do you recommend?
I recommend trying to make the best decision for you. That certainly you can change different levers. We haven't gotten to this part, but there is the deductible piece of it. And for those that aren't familiar with how deductibles work, that is the part that you're responsible for paying in the event of a loss. Typically, it can be anywhere from $1,000 to $2,500. So that's a form of self-insurance. So that's a question to ask. What is my deductible? If the premium is going to kind of knock off my debt to income ratio, maybe I can take a higher deductible, which will lower my premium. So there are things that you can do as a homeowner to try to still keep the all risk, still keep the replacement cost, but maybe the deductible is the place where you can, see some movement in that premium amount.
So, again, got to break it down. You need homeowners insurance.
Mm-hmm.
Somebody says, hey, use, many cases, because this is what I hear as a realtor, use the one that's working with our lender.
Mm-hmm.
They could have very easily, in order for you to qualify for your loan,
Mm-hmm.
they could have raised the deductible
Mm-hmm.
to $2,500. Let's say $2,500.
Mm-hmm.
And one thing, when I'm talking to people about insurance, I say your deductible should not be any higher than what you could actually come out of pocket with.
Right.
In the event of a loss. Mm-hmm. So you understand that if you have a loss in your house, something happens, a fire, a flood, a pipe breaks, or whatever, you're responsible for paying that $2,500.
Right.
And unfortunately, I see it too often. People do not have a particular repair, or they don't report a claim because they know they don't have the deductible.
Yeah, and that's unfortunate because usually the repair goes unfixed.
You're right.
And then it causes a bigger issue down the road.
You are so right.
Yeah.
Especially if that repair involves water, because then you go in there, now you're dealing with molds or whatever. Okay, now let's go back, since we're talking about premiums, and that's the big thing. What goes in to determining the cost of the coverage? And I want to deal with one particular thing. When I used to teach high school, and now automobile insurance, I love teaching automobile insurance, but it was so funny when I was teaching that, or when I talked to people about it, and I think the same would apply here to homeowners insurance. Oh, you drive that kind of car and you pay that much? I only pay this much. They don't understand a lot of the variables, and one of the main variables is credit score, because insurance is credit score driven. And they don't understand the impact of their credit score on the premiums. How big a part does that play?
It has become an increasing factor in the overall premium calculation, that certainly people understand, credit is important from a mortgage perspective. What they sometimes don't understand is that insurance carriers look at, it's not quite a credit score, what it's called is an insurance score. So we're not able to see the actual credit rating, but they use credit factors to come up with their own scoring system. So just like you would protect your credit because you're getting a mortgage, you need to protect your credit because you want to protect your insurability as well. One of the other factors that kind of drives that premium conversation are claims. That what previous property claims have you had? When you were a renter, did you file a theft claim? That follows you in terms of now getting a home. So while we definitely encourage people to have property insurance, what we caution them against is filing claims that they could have very well paid for themselves.
And see, a lot of people have the mindset, well, that's what I pay for insurance for. Why should I have to? But they don't understand that it follows them.
Right.
That's interesting. So we know now then, because everybody always wants to talk about their credit score. And even when I'm dealing with the mortgage lender, I try to let them know that we're dealing with different algorithms used to come up with whatever that score is. And so where we have a consumer credit score, the mortgage lenders will have their algorithm they use to come up with their score. The insurance company does as well.
Exactly.
Just another reason to make sure that you maintain or protect your credit. So let me ask you this, because we have a lot of discussion and we will be doing a lot of teaching on credit. Should a person improve their credit score, will the insurance company then go back? Could they call their insurance agent and say, listen, my credit score has increased. I'm up to 800 now, consumer credit score. Would an insurance company go back and look at that again and perhaps requote them?
Typically, because the insurance score has about 20 and sometimes 100 different factors, everything is not hinged on that credit score. So even if their credit were to improve, it may not make a meaningful change in terms of whether the premium is high or low, or whether they can offer coverage or not. So it's a little bit different than, say, getting a mortgage loan or an auto loan. It doesn't change the needle that much.
I'm trying. I'm trying to come up with some way. Okay, so we understand the things that would determine premium initially, the initial quote. We understand also about the deductible, the replacement cost, and the all-risk policy is what we want. I wanted to ask something else about these perils before we move on. Flood insurance. A lot of times, bless their hearts, when I'm taking people to look for a home, and right now,
it's hard out there.
it is. There's not much inventory. And I remember a client got very excited because we found a home. And I was like, why does house is staying on the market so long? Why has
There's
it
a
sold?
reason to this.
Yeah, what is up? What is up? And come to find out that it was in a flood zone. And so flood insurance is mandatory. That too, the lender has to factor in when they're coming up with a debt to income ratio to determine the mortgage. Why is this? FEMA's involved with this, and that's, I believe, you have to get the insurance through FEMA.
Yeah.
So therefore, that means a person would have the homeowner's policy that they have with their insurance carrier, but then on their mortgage statement, they will see an additional insurance premium from FEMA. And I believe that's a pretty much fixed amount, isn't it?
It is.
And do you know what that amount is?
It varies based on the amount of coverage, but it is fixed, and those prices are done by FEMA. So those are, regardless of the agent that you work with or the broker that you work with, it's going to be the same across the board.
Okay, so that's something that just kind of wanted to throw out.
Yeah. And one other thing that I think you mentioned about flood zones, all homes are in a flood zone. What makes it, I guess, mandatory versus not mandatory is if there's no water around your home, then you are in a low risk or preferred zone. If you are backing up to a creek or a pond that regularly overflows, and FEMA has documented that, that's where you then get into the mandatory flood situation.
Many people have financial questions and they don't know where to get answers. Now you do. We want to be your resource by providing you with educational information in a way you can easily understand from people you can trust. I invite you to send your questions to Ann at askannanything.com. Your questions form the basis of our show. Additionally, we offer live Zoom educational classes on home buying and credit that you will want to take advantage of. Remember, home buying starts with planning. For more information or to register for our course, go to askann.com. Now, if you enjoyed today's show, please click like and submit. I look forward to seeing you next time.